Can the SBI Life Smart Fortune Builder Plan be the ultimate strategy for building wealth while safeguarding your family's financial future? Let us find out in an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. But before analyzing this policy, let us first understand what is SBI Life Smart Fortune Builder Plan is about. So this is an individual unit-linked non-participating life insurance savings product. And some of the key features of this policy are, it gives you life insurance coverage throughout your policy term, and you have access to enhanced investment opportunities with a choice of 12 varied fund options. And if you have chosen the regular unlimited pay plan, then no policy administration fees will be charged you during your first 5 years. And also from the 11th policy year onward, there are no premium allocation charges, and guaranteed addition is based on your policy term. So the longer your term is, the higher your guaranteed addition will be. So these are some of the features. Now let's take a look at the benefits. So there are three kinds of benefits. First one is the death benefit. So death benefit is given to the policyholder's nominee or the legal heir in case of unfortunate death of the policyholder during the policy term. So as you can see from the three options given in the screen, any of these options, whichever is higher in value, that will be given as the death benefit to the policyholder's nominee or legal heir. So the option can be your fund value as on the date of death intimation, or your basic sum assured applicable partial withdrawal, or 105% of your total premium received up to the date of death less your applicable partial withdrawal. So out of these three options, whichever is higher in value, that will be given as a death benefit to the nominee or the legal heir. Another benefit is the maturity benefit. When the policy matures, so on survival of the policyholder up to the maturity of the policy, they will receive the benefit of the fund value, which shall be payable in a lump sum amount. Third option is the third benefit is the guaranteed addition. So on completion of specific duration and at maturity, guaranteed additions are rewarded to the policyholder. So if you are someone who has chosen regular pay or limited pay policy, then it is expressed as a percentage of your annualized premium. But if you have chosen the single pay policy, then it is expressed as a percentage of your single premium. So these are all the benefits you can get from investing in this policy. Now let us take a look at the 12 varied fund options available under the SBI Life Smart Fortune Builder Plan. So as you can see from the screen, the fund options are equity fund, top 300 fund, equity optimizer fund, growth fund, balance fund, bond fund, money market fund, bond optimizer fund, pure fund, mid cap fund, corporate bond fund, blue chip fund, and discontinued policy fund. So all these funds are categorized according to the percentage of allocation they have to equity and equity related instruments or debt instruments or money market instruments, and also according to the risk profile they have from low to high. So according to your risk tolerance and what kind of allocation you prefer in your fund, you can choose the fund options you desire according to what you need and what you think you will fit your investment portfolio the best. Now let's move on to understanding the charges that we have to pay under this policy. So first is the premium allocation charge. This charge shall be deducted from all your premiums as they are paid before the allocation of units. So each time a premium is received. So the percentage depends on your premium paying term and your policy here. Number 2 is the policy administration charge. This shall be deducted monthly, and it differs according to single pay or limited and regular pay policies. And there is also a fund management charge, which is according to the fund you choose to invest in. So whichever fund you have chosen, according to that, the fund management charge also differs. It ranges from 0.50% to 1.35%. And there are also discontinuous charges, which is calculated as a percentage of your single premium or your fund value, and it varies according to the year you choose to discontinue. Another charge is the mortality charges. So this is deducted each policy month from your fund value by way of cancellation of units. So this is charged based on your age and the sum at risk. Another is the switching charge. So a charge of 100 rupees is applicable for every switch you make. So in excess of 2 free switches in the same policy here during the policy term. Next is the partial withdrawal charge. Here also a charge of 100 100 rupees is applicable for every partial withdrawal in excess of one free partial withdrawal in the same policy year. So your premium isn't entirely invested in your selected fund right away. From this charges, we can understand that instead a portion of your premium goes towards covering these various charges, with only the remaining amount allocated to the investment. So they are not covering these charges from the gain of your investment. They are actually covering these charges, then only investing the premium. So what happens is it reduces the return over time. So unlike some other market linked products, this plan does apply various charges which over time can diminish your overall investment return, which you need to carefully consider. Now let us take a look at the advantages and disadvantages of investing in this policy. Let's start with the advantages. So first of all, a nominee has the option to receive death benefit payments in installment during the settlement period. Another advantage is that there are 2 fund switches per policy year, which is allowed at no additional cost to the policyholder. Another advantage is that premium redirection is also available starting from your second policy year, and partial withdrawals can be made from the 6th policy year or upon the life assured reaching the age of 18, whichever occurs later. And guaranteed additions also increase with the length of your policy term, providing higher additions for longer policy terms. So these are some of the advantages. Now let's take a look at the disadvantage. So as a disadvantage, there is a 5-year lock-in period in this policy, and there is no kind of loan facility available under this policy. And also, after applicable charges are deducted, only then your net premium is invested. So the life cover provided by this plan also seems to be insufficient. So these are also some of the potential risks you might be undertaking while choosing to invest in this policy. So carefully consider all these factors before deciding to invest in this. So now, as we have a basic understanding of the SBI Life Smart Fortune Builder plan, let us now evaluate the potential returns we can get from this policy, because no matter the benefits or advantages a policy can give you, what matters at the end of the day is the returns we can get. So that's where we are going to calculate the IRR, internal rate of return of this policy. So just for example, let's assume that a 35-year-old male has invested in this policy with a sum assured of 5 lakh rupees, and this plan, policy and premium payment term are set for 30 years with an annual premium of 50,000 rupees, and at the end of the policy term, accumulated fund value will be payable to the policy holder. As you can see from the policy brochure, it provides the projected returns based on assumed investment rate of 4% and 8%. So we are also going to calculate the IRR with these assumed returns, because it's important to remember that these returns aren't guaranteed and don't represent the full range of possible outcomes. This is just for example purpose. So the maturity benefit here will depend on various factors, including this plan's actual performance over time. So if we calculate the IRR based on 2 assumed investment return, like 4% and 8% at worst case and best case scenario respectively, we can see that in the 4% return scenario, the estimated fund value is 21.73 lakhs, yielding an internal rate of return of 2.30% as per the SBI Life Smart Fortune Builder Plan's maturity calculator. 2.30% is similar to the rate of interest you can get from a savings bank account, which means that if you have not invested your money anyways for such a long time and you have not taken such a risk, still you will get only a similar interest like this of your savings bank account. So what is the unique value it's adding here? Nothing basically. But this is for the worst case scenario, right? So what is the IRR in the best case scenario? In the 8% return scenario, the estimated fund value is 42.93 lakhs with an IRR of 6.13%, which is similar to the rate of inflation. But though the policy is 30 years, returns are not favorable for a long-term investment strategy, because over time the inflation will drive up the cost of your financial goals, and the returns from this policy may fall short of keeping pace. Why we are investing for such a long time with a lot of risk is because we want returns that can outpace inflation. So this suggests that a possible shortfall in achieving the desired corpus can happen if you choose this ULIP plan. That's where we are going to consider an alternative investment strategy and then do a comparative analysis just to see if an alternative investment strategy can give us better returns compared to this policy. So what we are going to do is, instead of investing in a ULIP-like policy which combines insurance and investment, we are going to separate these components and invest in it separately, like invest in insurance and investment separately using the same parameters as in the previous example. So for example, for life coverage, we are going to choose a pure term insurance policy with a sum assured of 5 lakhs, which costs 3,600 rupees annually as a premium for a 30-year policy term. So in the previous case, the premium was 50,000. But here the premium is only 3,600. So opting for a pure term policy leaves a balance of 46,400 rupees, which can be invested somewhere else. So your investment choice can be based on your personal risk tolerance. If you're a risk averse investor, you may prefer debt option like PPF because it is a government backed fund. It gives you guaranteed returns similar to the rate of inflation, and it also has tax benefits. So if you're someone who's conservative investor, then PPF might be a suitable option. But if you're someone who has a high risk appetite, then you can explore equity investment like ELSS mutual fund, which also gives you tax benefits. And if you take a look at the track record, there you can see that if you choose to invest in it consistently for 7 to 10 years, it has given an average return of 12% or even more than 12% in certain cases. So according to that, we have chosen these two options for two different risk tolerant investors. So as you can see, PPF investment, the estimated maturity value is 47.79 lakhs with an IRR of 6.70%, which closely matches the SBI Life Smart Fortune Builder plan, but slightly higher than that. But despite being a debt instrument, PPF does yield higher returns than the IRR scenario in the ULIP. In the ELSS investment, you can see the estimated pre-tax maturity value is 1.25 crores, but after capital gains tax, the net maturity value is approximately 1.11 crores with a post-tax IRR of 11.05%. So this approach clearly shows us that separating insurance from investment can significantly yield us better returns, even inflation beating returns, which enhances wealth accumulation and supports faster financial growth compared to the SBI Life Smart Fortune Builder plan. So what is the final verdict on the SBI Life Smart Fortune Builder plan? From our analysis, we can understand this policy combines life insurance with market-linked investment, but like other ULIP plans, it comes with various charges that reduces the amount available for investment. Our return analysis highlights that this policy's real impact shows us that its long-term returns are relatively low. For a market-linked product, such modest return suggests an imbalanced risk-to-return ratio. Additionally, the sum assured may not be sufficient to meet a family's basic financial needs in the future, potentially hindering your overall financial plan in the long run. So on the whole, the SBI Life Smart Fortune Builder plan is not the right choice for wealth accumulation in the long run, and this policy also has a high agent commission. So what can you do instead? From our analysis, we can see that you can opt for a pure term life insurance policy, which can be a better option for life coverage because it offers essential financial protection for your family with a higher coverage at an affordable premium. And to achieve your financial goals with an investment that can give you inflation beating returns, you can build a diversified investment portfolio across asset classes and keep your insurance and investments separate. So definitely you can do all these things to achieve a more desirable outcome.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.